Good morning and welcome to your Financial Empower Hour. This is Jason Cryderman with Great Lakes Investment Advisors, and I'm here again with my awesome co-host, Mr. Tony Shore, over in the Minneapolis, Minnesota area. Tony, what's happening over across Lake Michigan today?
Well, I'll tell you what, it's supposed to hit 63 here today. On Friday, it hit 73. And Wednesday, we're supposed to get 5 inches of snow.
Okay, so we're going to start right off with this awesome weather we've been having. And when I say that, everybody over here listening right now knows that, wait a minute, Jason, it hasn't been that awesome because, so again, as we record this on Monday, it airs the following Sunday. So Friday here, Tony, it was about 76 degrees, gorgeous, beautiful sunshine.
Same here.
Saturday was pretty nice outside. Sunday was, I think it got up to like maybe in the 30s, but we had an inch of snow on the ground. It was horrible. We woke up this morning, it was 19 degrees. Like, what the heck is going on with this weather? It's crazy.
Yeah. We're actually, by this afternoon, it was 30 or 29 when I got up this morning here in the Twin Cities. And then by this afternoon, it's supposed to hit 63 later this afternoon and be sunny. And then by Wednesday, blizzard and freezing.
So there's another one coming. So no, you guys can keep that one. So that one that hits you Wednesday, like just stop it right there, keep it, or send it straight north or straight south. Either way, send it to Canada or Chicago. Either way is fine with us. Just don't let it come across. And
we'll send it down to Kansas. Those people deserve it, right?
Those people in
Missouri,
Kansas love that kind of weather. Yeah, absolutely. They love that kind of weather. And so but it's been crazy up here. You know, we got a really nice taste of spring. Like I mentioned, it was pretty nice for a couple of days there. We had in the 60s and 70s, and man, it sure is nice. It gives you that little spring itch, and you want to get outside and you open the windows in the house and let some fresh air in. And so that was pretty nice. But we're kind of having a shift in weather as well. It's back into cold and icy and snowy. And I looked at the forecast. It looks like we're going to be hovering kind of between, I think, the 30s and the 60s, like you mentioned, bouncing back and forth a little bit. But again, that's over here. That's what we call spring in Michigan. I mean, it's, if you don't like the weather, just wait 5 minutes. It'll change. And
right.
Mother Nature throws some crazy stuff at us over here, and I'm sure they do it with you as well over there. And but I think, spring's upon us. Here we are on St. Patrick's Day. So as we record, Tony, happy St. Patrick's Day to you.
You wore green today. I forgot. I just grabbed this, and then on the way to work, I'm like, wait, it's St. Patrick's Day. We kind of celebrated on Saturday, and so I forgot today's the actual day. I'm half Irish. Did you know that? I'm 50.
I didn't know that.
A full 50. Yeah, the full
and of
50.
all the Irish people out there, and you don't wear green on St. Patrick's.
I know everybody else here is wearing it. They're not Irish. I'm 50% Irish, and I'm not. I mean, I'm half English, half Irish, so I'm always at war with myself.
Always battling. But I tell Always a battle.
It is a battle. Yeah, you know that. It's always a battle for me regardless, but especially because of my heritage. But yeah, happy St. Patrick's Day. I love this day. I remember my grandpa Whelan, whose dad is from Ireland, and my mom's whole family Irish. And, it was always just a great day. And my grandpa always wore the little Irish cap, that you see over there.
Oh, yeah.
It's great. We celebrate it quite a bit. And actually, St. Paul has the world's second largest, or the United States' second largest Irish fair.
Oh, really?
That's in August. And so I always go to that. And the guy who runs it has the last name of Whelan, which is my family's name.
Okay.
So, it's really fun. I really enjoy it. And I enjoy St. Patrick's Day. I appreciate my heritage. And so that's always great. But a lot of people use it as an excuse to have fun. I see you wore green. I'm proud of you.
I wore my green. And actually I wore my green partially for my Spartans.
Michigan State Spartans.
As we can see
Spartans.
there. So this weekend,
I told you before the show, I'm a fan.
Yeah, and I love it. So I appreciate that. Especially being a Gopher over there with the Minnesota Gophers and everything. But to be a Spartan fan, we appreciate that. It was a little rough weekend for us. We had the Big Ten tournament. We were looking really good. We played a couple great games. Just the ball didn't bounce our way coming into the end of the second half there in the semifinal game on Saturday. So we ended up bowing out of the Big Ten tournament. our in-state rival Michigan ended up winning yesterday. They won the Big Ten tournament. So at least if it's going to be a team to win the Big Ten, we do cheer for Michigan, even though I'm a Spartan by heart. That's where I went to school. That's where my wife Amy went to school. That's where we met each other. Lexi, our daughter, has committed to go to Michigan State this fall. So we're Spartans through and through. We bleed green and white. But, again, congratulations to the Wolverines for winning the Big Ten championship. That's awesome. And we'd rather have it be here in the state versus that state just south of us that starts with an O. We definitely don't want them winning anything. But we're getting ready for March Madness too. So we saw that yesterday the seeding came out and Michigan State pulled the number 2 seed for the big tournament. So that's exciting.
Yeah.
So we'll see. We'll see how far they can go. I've heard a little bit of both. Some people say they're gonna go out early. Some people say, man, they're driving right till the end. And of course, when you have Tom Izzo as your coach, and he's known as Mr. March. It's amazing what that guy has done with teams and players, especially getting into March Madness time. It's just absolutely amazing. You never know what could happen. So. Yeah, we're definitely watching a lot of Spartan basketball over here this time of year.
Oh, sure, yeah, and I'm also I spent a lot of time as a kid in Omaha because my aunt and uncle live there. So I'm also a Creighton fan. They have a great basketball program there. They're pretty well known, but they're in the Big East. They're called the Big East, and they lost this weekend in the champion. They were the number 2 seed, went all the way to the top and lost to St. John. So that was a tough loss because I was following them, and they really they destroyed UConn. And so I was really hoping that the Creighton Blue Jays would go all the way. And Omaha deserves it. They need it. That poor town, they don't have any pro sports teams. They're not like you and I, where we have a lot of different teams to support, right?
And you would think, Nebraska's got the Cornhuskers, they got those schools, but you're right, they just don't have those pro teams, and they just don't have the population for it. But to see their college teams do so darn well,
Creighton does pretty well. They've won a few championships, and they're always there, they're always in it, and they were the number 2 seed this year and almost won it, but they struggled in that last game against St. John, the championship, when they needed it. They won every game going up to it, and I thought, they're going to.
That's kind of like our Spartans. Yeah, that was like Michigan State. They kind of did the same thing.
Yeah, exactly.
Just couldn't pull it out there at the end of the game on Saturday. Just couldn't quite pull out the W. But
so are you still in the lull with all your kids, Jason? I know you guys are always running around with your kids to their extracurricular activities.
Yeah.
Sporting, cheer.
Right now we're kind of still in the lull as far as the girls are doing track for Meridian High School.
Sure.
And so they've started track practice as of last week. So they're practicing every day after school, but they don't have their first track meet, I think, until mid-April. So we got about another 3 weeks before we get heavy into track meets. And then Carson, he's been doing his travel baseball, basically his winter training. They've been practicing indoors twice a week. And this past week, it was nice enough we were able to get outside and have practice. Yeah, both on Thursday and Friday nights, they got to get outside, and it's awesome. It's just phenomenal when you get to get outside. Your first practice is in the spring, get out on the grass and the dirt and the fresh air, and run around outside versus being, cooped inside. So, but right now, I think Carson's probably got about 3 to 4 weeks before his first tournament as well. And then it's going to be almost weekly tournaments all the way through June, July, and Little League ball and travel ball. And then the girls will have track meets. It's 2 or 3 track meets per week all the way through the end of school, which will be, I believe, like the first week of June. So we're kind of in that lull right now. You're right, Tony. We're in a little bit of a slow time, the calm before the storm, Amy and I like to call it.
Yeah.
And but this is a great time. We get a lot of family stuff done this time of year. We got a lot of stuff done around the house, projects that we've been putting off all winter because during the winter we were so busy. Well, fall and winter with football and cheerleading and band, and the girls with their cheer competitions, and just kept us really busy. So now's the time when there's this little bit of a calm. Amy got some painting done around the house this past weekend. I'm starting to get some more work done around the house and the yard that we haven't had time to do. So it's a little bit slower time for us, but we stay busy.
I know you do. I know you do, Jason. And then, of course, your main concern and what you spend most of your time with is helping people in the community at Great Lakes Investments with their finances and their retirement planning. And I know we have a lot of listeners and viewers out there that watch or listen to the show each week that might be thinking about downsizing. And my wife and I, we've been in the same house over 28 years.
Wow.
And we've collected and we raised 3 children there.
Oh, yeah.
We have so much stuff, Jason. So
it's amazing how much stuff you can accumulate.
Oh, it's ridiculous.
Just by accumulating. It just naturally happens.
It does. It does. And we can't wait we're just so excited to just get rid of stuff and downsize. So I know we'll probably do a whole show on downsizing sometimes.
I think it's a great idea.
At some point. I mean, that's not what we're talking about specifically today, but I brought it up because I know that's a big part of what you do when people come in and you have to plan out their finances. Well, when you get toward retirement or in retirement, are you planning on downsizing? What are you going to do for a house or with your house? And usually that's the biggest asset people, for a lot of people, their house might be their biggest asset they ever have.
That's true. Yep.
And so what's going to happen with that? And we're starting to look around or think about, hey, it'd be nice to have a place where we could just, age gracefully. We're not quite there yet as far as retirement, but we're thinking ahead. We're trying to think ahead. We get that from you. You're always saying, plan ahead, plan.
Absolutely.
Right?
The more planning ahead of time, the more proactive you can be, the easier that transition, and usually the more successful that transition will be as well.
Yeah. All right. So before we jump into today's topic, which we're going to talk about the market volatility that's been going on and some things you can do as far as your finances, especially if you're getting closer to retirement or are in retirement. Before we jump into that, if our listeners out there have questions about what we talk about today, or they have a financial concern or want to get a retirement income plan in place, how can they get a hold of you and do that?
Well, the two easiest ways are, first of all, the internet. Jump on our website at greatlakes.investmentadvisors.com. There's a lot of awesome information on there. There's resources. You can listen to previous or even watch previous radio or YouTube shows. And then there's a link on there. You add your information and you hit submit. We get a direct email immediately, and someone from the team can reach out and get us connected for a phone call or an office visit, or even just grab the phone and give us a call at 989-835-7203.
All right. And we're going to be giving away copies of your book, Empower Your Retirement, a bit later in the show. I want to make sure our listeners stay tuned for that. And we're going to be right back and talk about this market volatility. All right, you're listening to Your Financial Empower Hour. I am your co-host, Tony Shore, and I'm here with the man himself, Jason Cryderman. Jason, we're talking before the show about the markets a little bit. You and I always chat about what's going on out there. And, I hope our listeners aren't panicked if they're watching the 24-hour news cycle or CNBC or Fox Business News or reading the internet. They might think the sky is falling. But let's talk a little bit about where the markets are at. I know last week in particular was one of the worst weeks for the market in a couple of years, and especially even the S&P 500, which has been kind of the cream of the crop, or the golden standard that everybody looks at. It lost, I know at one point it was down almost 10% last week. But it's been up and down. There's been a lot of volatility so far this year, right?
Yeah, there really has been. We like to use the term turbulence. There's a lot of turbulence in the markets right now. And a lot of it really, we're going to talk today in the show about the big picture. We're going to talk about not only the big picture moving forward and how you plan and manage your money, but also want to talk about the big picture looking back. And when we talk about the markets today, Tony, let's make sure all of our listeners and viewers understand we're primarily going to be using the term S&P 500, which is the Standard & Poor's 500 stock market index, 500 of the most common household largest companies here in the United States. So that's what we're talking about when we talk about the markets. And the S&P has been used, as you mentioned, Tony, kind of as our standard benchmark, if you will, benchmark for when people say the market's up, the market's down. Most of the times they're talking about the S&P 500. It's a very broad index. So You're right. We're seeing some volatility right now. We're seeing turbulence. And so, first of all, I just want to reiterate out there to all of our listeners and all of my viewers, turbulence can be okay if we plan and prepare for that. As we just talked, Tony, that the more you can plan or prepare for you and your wife to downsize the house and start getting rid of stuff and get rid of what's this next phase of life going to look like, maybe a smaller home and getting into retirement. Well, the more you can plan and prepare that ahead of time and work on it gradually, the better that transition and the more successful it's going to be. No different than your financial planning. No different than almost anything we do. If we plan a trip, there was a statistic a couple years ago that said the average retiree spends more time in a year planning their next vacation than they do on their financial planning. And to me, that's crazy. It just, we need to spend more time being proactive and planning ahead of time with our money. And those of us that don't, those of you viewers or listeners out there, if you're not putting in enough time doing your own proactive planning or working with another trusted fiduciary advisor, if you're not putting in the time ahead of time, you really can't be too upset when you don't maximize the benefits. Some people say, gee, the market was up, last year in 2024, the market was up over 20%. And some people come in and say, gee, I didn't make that. Well, did you plan for that? Did you prepare for that? Well, no. Well, then you can't be upset with it, right? You kind of have to take some of the responsibility on yourself between you and your advisor. And right now, the market, the volatility is there. Year to date, if we look at like the S&P, for example, year to date, it's down about 4%. S&P is down just over 4%. And so if you're down 4% and you're thinking, wow, I didn't want to be down that much, what did you do in the last 3 to 6 to 12 months to try to plan and prepare for, if the market goes down, I don't want to lose as much? And if you tell yourself, what, I really didn't do anything, I just kind of stayed the course and kept the same funds I was in before. And, well, then you really can't be too disappointed or upset that, gee, the market's down and so are you. Again, the more you can prepare and plan ahead of time, when the market goes up, here's what I want to do. Here's how much I want to participate. Then you need to be proactive with, here's the types of management philosophy, here's the types of tools or investment, and maybe the type of advisor you should be using if you're in that growth phase, if you really want to maximize your growth and be up as much as the market is.
Yeah.
And then the flip side of that coin too is, Tony, and you and I have talked about this even with your family, is, when you get ready for retirement, whether maybe it's that 1 to 5 years before retirement, which we call that retirement red zone.
Yep.
That's when you need to start planning and preparing ahead of time. How much risk exposure are you comfortable now as you're getting into retirement or getting that close to the finish line? And my guess is it's a heck of a lot different for every single one of my listeners and every single one of my viewers out there. Your risk tolerance in retirement or at 60, 65 years old is going to be a heck of a lot different than your risk tolerance was at 30 and 40 years old.
Oh, for sure.
And you and I have talked about it, Tony, right? Even you said you and your wife are not as aggressive as you used to be.
Right.
You're becoming a little more preservation minded.
Yep.
Realizing the reality is, as we age, we don't have as much time on our side.
Yeah.
We're not contributing, or may not be at some point in time contributing to our retirement plans, like our 401ks. As a matter of fact, at some point, we might even be taking income out of those types of investments, the 401ks, the IRAs, the Roths. And so it's a different management philosophy. Again, sometimes it's a totally different advisor, because there are advisors that specialize in certain areas. For example, there's growth, wealth accumulation advisors, and then there's preservation. And my team and myself, for 22 years now, we've really focused on that wealth management, wealth preservation, income planning for your 50s and 60s and later in life. And so, again, it does take a different philosophy. It oftentimes takes a lot of different tools and investment products. Some of those tools and investment products we're going to touch on today, because some of them, Tony, as you know, and we know, we talked about some of the tools and investment products, especially once you get into retirement and you're not limited to just the options inside of your 401k. That's a big deal, that people, once they realize, wow, when I retire, or if you're 59 and a half and your employer allows an in-service rollover and you're still working, you can maybe take some or all of the money out of your 401k and have it managed more for retirement.
Yeah,
Because
I think that's huge. But let's take a break before we go into those different types, because I think that's really important, and I want to really focus on that because you're right. A lot of people retire. The majority of people today retire with some type of employer-sponsored account, like a
retirement plan, like a
401k,
401k. Yep.
403b,
Mhm.
TSP, 457. So let's talk about, they think, okay, I've got this lump amount, I've got a 401k, I'm going to pull money from that, and that'll be my retirement income. It's that
Correct.
simple, right?
Yeah.
No.
Well, a lot of people think that, but again, as we get into through the rest of the show today, and what I have conversations with all of my families and investors is, for the last 20, 30, maybe 40 years, you've been in the growth accumulation phase. So now to shift into the preservation and income phase, that is a huge psychological change. It's
Yep.
not that easy. It's
Yeah.
not that easy, especially if you keep using growth vehicles to try to do preservation and income. It's almost trying to put a square peg in a round hole. So we'll talk about that more throughout the rest
well,
of this.
it's going to be a costly mistake that could cost you your
Very well
retirement, because
extremely costly.
you're going to deplete your retirement income so much quicker.
Potentially, yep.
But potentially you could do that. You could easily make those mistakes, and you want to avoid that. So before we do that, I want to give away 10 copies of your book, Empower Your Retirement. I think it's really, really a great book, Jason. Now we're going to let the next 10 people that contact your office and say, I heard about it on the radio show, I want a copy of your book. All they have to do is call 989-835-7203. That's 989-835-7203, or they can go to GreatLakesInvestmentAdvisors.com. And again, that's GreatLakesInvestmentAdvisors.com. And you can contact the office there and fill out a form. They'll get back to you, and then let them know you want them to send you a copy of that book. Now, Jason, great show so far today. All right, and we're here on your Financial Empower Hour. We gave away 10 copies of that book. I'm excited, and if people are listening to this on the podcast, there might be still some copies available, so make sure that you do call in 989-835-7203 and ask for your copy of Jason's book, Empower Your Retirement. There's no charge, no obligation, or set up that consultation if you have questions. Now, before the break there, we were talking about the different types of vehicles and different ways to save for retirement. We know about saving for retirement, but the different ways to draw income, I should say, from in retirement, right?
Yeah. So a lot of people that we've met over the years, Tony, as you mentioned right before the break, mostly families, most people out there, most of my viewers on my YouTube channel or the podcast or listeners on the radio, most of you have some form of retirement plan from an employer, like a 401k, 403b, 457, TSP, those types of employer sponsored plans. It's very common that when you get ready to retire, one of the options you have is to leave the money inside the 401k plan or the employer-sponsored retirement plan, or you can move that to a different plan, like an IRA. Or if you have a Roth inside of your 401k, you'd want to open up a Roth IRA as well. It's very common to move those funds out. Now, what a lot of people aren't aware is you have that option. You're not forced to for most employers. That's a choice you have. And, some people just say, well, I'm really comfortable. I've had this 401k for 20 years and it's done very well at growth and I've made X amount of dollars. And so I think I'm going to keep that account. Well, one of the things, Tony, that we really pride ourselves on educating the public on is the limits and restrictions you have within those employer-sponsored plans. You're limited and restricted to the custodian. For example, if you use like Dow Chemical here in town, they use Fidelity. And Fidelity is a great company, huge company. But if you said, gee, I want to put some of my money somewhere else, you can't do that with the 401k. Dow gets to pick where it's at. Inside most 401k plans, you also have a limited number of investments to pick from. 10, 15, 20, maybe 30 options. And as good as those options have been, growing your wealth over the years, which most options inside 401ks are designed more for growth, not as much for preservation or income. But as good as those tools have been, when you get into retirement, there's so many more choices and options of investments. If you move that money out of the 401k into your own IRA, you now open up a huge wealth of choices and options to invest that money in. And some of them you may want to put in more preservation minded, meaning safer, and maybe into income driven, where immediately or somewhere down the road, you're going to turn a portion of that asset into income. And
Sure.
we call it mailbox money, right? A lot of people like mailbox money, where they know the first Tuesday of every month, that's, maybe twice a month, just like when they were working, they were getting a paycheck. You can continue that into and through retirement through investment tools and vehicles that are designed to provide you with that guaranteed monthly income for the rest of your life.
Yeah.
Generally, you don't get those options inside of an employer-sponsored plan.
Right.
So that's where, Tony, we've been able to educate and help a lot of investors and families transition from the employer plan into your own personal plan, where you own it, you control it.
Take that 401k or IRA and create your own personal pension with a portion of it. Yeah.
Yep. Absolutely.
Yeah. And I think that's really helpful. Now, and the guarantees, if it's it depends on what it is. If it's a buffered index portfolio, there's principal protection or downside protection on some of those. And it's by the investment firm or bank or company or insurance agency. It's based on their claims paying ability. And that's why, as an independent, you just work with the top rated companies. You look at all the different tools available from the different, you can pull from anywhere, and you're going to look for what's in your client's specific personal best interest. In other words, what is going to be in their best interest and to meet their goals and their personal risk tolerance. Because you said earlier, everybody's different, but you have to have that balance. A lot of people think, well, I've got all my money in the stock market, but I'm balanced. I have a diversified portfolio, so I'm ready for retirement. Well, no, everything's probably still at risk.
Yes.
So
it could be at some level of risk. Absolutely.
Yeah. Yeah. So you want something with some principal protection once you're in retirement, and you do that for your clients just so they don't have to panic each time the market has a 10% correction, right?
Yeah, absolutely. I mean, and that's one of those things, again, the more proactive you can be and the more you can plan and do this ahead of time, and not only ahead of time, Tony, but, we talk about all the time as well, as continually monitor, review, and update your plan. And we sit down with most of our families on a quarterly basis, semi-annual or annually. And that's just to stay on top of things, stay on top of how are we doing? Do we need to make any reallocations, rebalancing, any adjustments? How are we exposed to too much risk? For example, right now there's a lot of volatility out there. So some vehicles that we're helping families investors employ right now, and we've actually been using these vehicles, again, proactively. We've been using them way before it started getting volatile this year, where you might say, gee, out of my portfolio when I retire, I want half of my money safe and protected, and I want the other half more moderate or aggressive, more growth oriented. Well, then you got to make sure you're using vehicles that are designed to do that. And you already mentioned a couple of them. When we talk about safe money, when safe money really should have no risk, should be principal protected, should truly be safe. And those are like CDs, money markets, savings checking. There's forms of bonds like that. There's fixed annuities. There's multi-year guaranteed annuities. There's index annuities. Those are all types of vehicles that are safe. They're guaranteed principal protected. They have no stock market risk at all. Those are appropriate for some people and some of your money. They're definitely, Tony, not appropriate for everybody, and definitely not appropriate for all your money. You don't want all your eggs in one basket.
Right.
Because all investments, as we know, have pros and cons. They all have goods and bads. They all have limitations.
Just like you don't want to take all your entire retirement nest egg and leave it all invested in the market. You want some of that. You want some of that in other places. Some of it even more liquid than the stock market. Some of it, you need the growth, but you also need some safety once you're in retirement, don't you?
Yeah, you sure do. Most people do. They want to build safety somewhere in the portfolio. And again, you can do that through some of those vehicles we just mentioned. There's also, you mentioned a really neat one that you can still stay what I'll call in the market for the most part. It's through what's called a buffered index, and Gradient Investments manages portfolios of buffered indexes. And these are generally anywhere from a 12 to an 18 month, maybe as long as a 2-year term. So fairly short term. They're still semi-liquid because there are ways to access or get money out with a very small fee. But they're really cool because like right now, for example, you could get into an 18-month buffered index, Tony, that would allow you over 13% of growth on the upside. So if the S&P 500 over the 18 months goes up anything up to the 13%, you get to keep 100% of it. If it goes up over 13%, well, you're capped out at the 13. So if it goes up 15, you make 13. And I don't know anybody right now that think, gee, with my safe money over the next 18 months, if I made 13%, would I be upset? Probably not.
No.
Probably be very happy with that. And remember, this is for our safer money, right? And the real powerful thing with these buffered indexes, Tony, is the protection. Right now, 100% of the money is protected from any and all downside risk. So at the end of the 18 months, if the S&P or the Dow Jones closes below what it started at, there's no risk. There's no loss. The only thing that would come out of the portfolio would be fees, obviously the management fees. But buffered indexes are really, really cool to say, hey, I still want some of that awesome upside potential. I want to make 8, 10, 12%, but I want to protect some of this money. And so we're utilizing buffered indexes. And again, these aren't new, Tony, and we're not employing them just now that the market's volatile and it's down 4% year to date. Yes, we're putting some of these into play today, but most of our families that I manage money for have had buffered index investments in their portfolio for the last 3 to 5 years or more.
Yeah, they've been around. They've been around about 5 years, but they've gotten better over the years. You have to say, I mean, and people might think, well, that sounds too good to be true. I can participate in up to 13% of the upside of a market with a particular buffered index portfolio, and then no downside. Why is that? It sounds too good to be true. And we've asked the president himself, Mike Binger of Gradient Investments,
Correct.
and I've watched other investment firms talk about these. And the reason is, it's the same reason fixed index annuities have changed so much in advantage of the consumer and gotten so much better, is that they're getting competitive. They don't want you to put all your money in the bank or in a CD. They're competing with banks. They're competing with other insurance companies. They're competing with other investment firms to have the cash flowing through them. Correct. And so they're sweetening the deal. Yep. So you will invest with them and say, hey, if we've got this deal, we're going to get that money to put in our coffers to earn us interest, and we'll have to pay out interest if the market goes up. We'll have to cover the downside, but they say if we get enough people, it'll be good for us, and because that gives us more funds to work with. So that's how it works. It's just like how a bank works. Every bank wants everybody to put their money with them, and that's why they have great deals once in a while on CDs, because they're trying to make them more and more attractive. And banks have kind of tried to do that when the interest rates went up. They were able to offer some more and get some more money flowing through. Yep. And when interest rates were zero, a lot of banks went under or some banks, didn't do as well. They didn't do as well. Bought out because of the fact that they were unable to offer these deals. But I really think that it makes sense to look at your specific situation. And I think the key here is you have to work with a financial professional. And speaking of that, we're going to give away, I know you've set aside some time slots to offer our listeners and viewers out there a complimentary, no cost, no obligation consultation. All they have to do to get a no cost copy of your book, there's no charge, there's no obligation. Call in, say you heard about it on the radio show, set up a consultation with the team there at Great Lakes. The number is 989-835-7203. That's 989-835-7203. Say you heard about it on the show. We're giving away another 10 copies of the book. We'll mail those out at no charge. Or you can just set up an appointment. You'll get one when you come in, and you'll get your questions answered. And again, there's no obligation or charge for that consultation. So we're back with your Financial Empower Hour. It's been a good one so far, Jason. We're talking about the market volatility, and boy, has it been crazy, right?
It has been. It's been crazy. I mean, and we talked earlier in the show about, planning and preparing ahead of time and looking at the big picture, not just, in the last month or year to date. Here we are as we're recording this show. It is March 17th, the S&P 500 down over 4%. Well, first of all, let's put some perspective on that, Tony. So the S&P 500 as a benchmark of our economy, averages on the downside anywhere from 5 to 10% down per year, about 2 to 3 times a year. That's normal. So for the market to be down maybe 5 to 10%, that's normal. That's okay. And actually, volatility brings opportunity. Because if the market just kept going up, everything's always getting more expensive. How can we afford to buy? Where's the opportunity to buy in, right? And we're supposed to buy low, sell high. So now when the market shows itself some volatility, what we try to do as financial advisors is we try to help families, first of all, protect as much of your money as you possibly can. But second of all, look for opportunity to buy low. Now is a great time to rebalance the portfolio, maybe look for some discounted value, something that is down a little bit, but has potential to go back up. We can buy low, ride through the long term. And so then we're able to sell high when things do go back up. So volatility is normal. Volatility is okay. I think we're kind of positioned for that. If you look at where the market was, Tony, from 2023, the S&P was up over 20%. 2024, the S&P was up over 20%. How long can that continue? Where the S&P, the stock market, just keeps going up and up and up, double-digit growth every year. That's not healthy and normal.
That's not.
It's not healthy, right? So we were kind of seeing, we were kind of positioning for a little bit of a correction and pullback this year, anyhow. And we did about a month or two ago. We did an episode called "Bring Your Umbrella," take your umbrella with you, and that was about, hey, the sky's not falling, but we're going to see a little bit of volatility. It might rain, and that's okay. Rain is okay as long as we're prepared. Bring the umbrella. And so right now, I think most analysts were looking for a little bit of a market pullback or correction this year anyhow. Probably, I think wherever I heard was a lot of analysts were calling for maybe a 6 to an 8 to a 10% growth year, not 20 some like it has been the last 2 years. And of course, then you had change of presidency. You had one party go out, one party come in. That's some change right there. Some uncertainty. Market doesn't really like uncertainty. So there's some volatility there. And there's a lot going on right now with the current presidency. And there's a lot of these tariff things. We talked about that on last week's show with Keith Gangle. And there's goods and bads there, right? So a lot of this stuff, I think we just have to plan and prepare ahead of time. That if these tariffs come into play, and if the market does fall 20 or 30%, what are you doing in your portfolio to protect as much of that money as you want protected? And maybe some of my listeners and viewers are saying, I don't want any money protected. I'm okay with all the risk and growth. Well, then that's okay. Then to be expected, right? But for those of us that say, well, I want to protect 25 or 50% of my portfolio, I just can't afford any risk or loss on this portion of money because it's going to probably be money I want to preserve and maybe even get income off of immediately or down the road in retirement, then you want to use those types of vehicles, Tony, that we talked about earlier on the show, like maybe a multi-year guaranteed annuity, maybe a fixed indexed annuity, maybe a buffered index portfolio. Those are all vehicles that are 100% principal protected. They all have their pros and cons. They have their pluses and their minuses. We'll talk about those one-on-one to make sure from a fiduciary standpoint, we're putting you in vehicles or investments that are truly 100% in your best interest. We do believe diversifying. We don't believe all your eggs should be in one basket. Even, a couple months ago, you could get a CD for over 5%. Not appropriate to put 100% of your money in one CD. So, but you need to be aware that those other vehicles do exist. There are options. Now, as I mentioned in our last segment, though, Tony, most 401ks only give you a limited choice of options, 10, 20, maybe 30 options to invest in. And most employer-sponsored plans like 401ks don't allow you things like we've talked about, like the multi-year guaranteed annuity, which is a guaranteed rate, or an index annuity, or a buffered index. A lot of those vehicles you don't have access to through an employer plan, but you would have access to those if you work with a fiduciary advisor like myself or another member of my team. And we were able to employ these types of vehicles outside of the 401k or the retirement, the employer-sponsored retirement plan.
Yeah. And it's so important because, again, people are so used to saving and accumulating. What we're doing during our working years, we take our income and we use it to create a savings, right? For retirement. That's what a 401k is. And that's what other means of saving for retirement are investing. That's mainly why people invest. Well, for that growth, for money for later. But what happens in retirement is it's a complete 180. It's a complete reversal. It's the exact opposite,
sure
isn't it? From what you're saying
sure
is what you do is you have this lump sum. Instead of taking your income and creating a savings, you need to take that savings or that lump sum, your 401k, your IRA, and you need to somehow turn it into a monthly income that will last as long as you do. And that's the trick. And that's what's hard. And people can't do this on their own. There's too many moving parts and too many options. You don't want to make costly mistakes, right? So that's where you come in. Have a written plan, have a plan to make sure hey, I'm going to have X amount of money every month as long as I live. That's set. We've got a plan for that and plans for inflation, healthcare costs, taxes. You bake all that into the plan, so that's covered. And it's so important. And that way you answer the question, do I have enough? Will I have to work a little longer? Will I need a part-time job in retirement? Could I retire right now, whether I'm 45 or 55 or 62 or 63? It doesn't matter, or 65. When can I retire? And you answer that question and can help people with this. Again, we're going to leave people with this. And Jason, why don't you let our listeners know how they can get a hold of you to set up that no charge, no obligation consultation and get a complimentary copy of your book?
Yeah, that's definitely an offer. I love, Tony, that you started giving away copies of the book. So if you would like a copy of the book that my dad and I wrote, Empower Your Retirement, just give us a call here at the office, or if you'd like to set up a phone call. Some people they listen to these radio shows and say, gee, I got a question I want to ask Jason, or I want to ask one of the Gradient Investments portfolio managers. Or maybe you have a question about what's the weather like over in Minneapolis this week, and you want to talk to Tony Shore. Well, just give us a call. Give us a call here at the office. We can set up a phone call. We can set up an office visit. We can go over your current portfolio and give you a second opinion. We can help you maybe put into place some of these retirement income planning vehicles that you haven't had access to through your employer 401k, or just kind of help you figure out, are you on the right road? Are you ready to retire? When can you afford to retire? Make sure you got all those retirement income roadblocks kind of taken care of, so you can go into a successful and happy, hopefully long retirement. So give us a call here at the office at 989-835-7203. Again, that number here at the office is 989-835-7203.
All right. And that does it for today's episode of Your Financial Empower Hour with our host, Jason Cryderman.